So today I'm gonna make an attempt to explain the current situation in the marketplace. I'm gonna analyze whether or not we are in a bubble, an asset bubble, or an AI bubble, or whatever bubble people are talking about at the moment. We do see that there are some fear out there in the market, and obviously, as you seen in my last video, Bitcoin has fallen down a bit, and also some popular stocks has get hit by this downtrend. For example, AMD, Oracle, etc. So we're gonna take a look at that, and I'm gonna talk about whether or not this is something that I'm afraid of long term, and we're gonna connect this to the soaring debt levels in the world, and also the Federal Reserve and the policies they are doing, and what we can expect going forward, and what their the type of place that they do there at the Federal Reserve, if that is actually affecting the stock market at the moment. So here we can see Oracle stock taking a massive hit from the highs here, around $320 per share. Now it's 198.7, so it's under $200. So a drastic downturn and a lot of money lost if you are selling at the moment and were buying at the top. So I can say that this is really affecting some stocks out there. Same with AMD, one of my favorite stocks. It has been hit quite hard from the highs here. Now it's down to around $200. So that's also indicative of something. And you can see here that the Nasdaq as a whole has taken a downturn here from its highs. But if we take a broader look at it, since the beginning of 2023, we still see Nasdaq a lot higher. So saying that we are in a crisis or a bubble based on a couple of stocks taking a downturn, I would say that's a bit harsh. So there are some specific stocks that has taken a bigger hit. I would also say that probably Micron, who makes memory for the AI market, CPUs, GPUs, etc., has also taken a hit from its high. You can see here. So obviously the Nasdaq as a whole and other indexes has done better than some specific um, stocks here in this semiconductor space. So that's something. Obviously, we see that some stocks are getting hit here, but anyway. So this is the Federal Reserve's New York President John Williams, and we're gonna take a look here where his take on where the rates are going for the Federal Reserve, and whether or not we can look forward to a rate cut, or if we're gonna stay where we are at the moment. And obviously, this is can be important for the the market as a whole, and also for U.S. citizens, etc. And it can also affect the world because the United States of America is the world's biggest economy. And lower rates can mean it's cheaper for companies to borrow money. It's cheaper for the government to borrow money, and quite often is a bullish sign for the stock market. But at this moment, everything depends on what's priced in. So if a lot of investors are expecting a rate cut and it doesn't happen because the inflation is sticking too high, obviously that can mean has negative implications for the stock market, because a lot of things are priced in going forward, and obviously 3 to 6 months is especially priced in. So this will be interesting.
Monetary policy is very focused on balancing the downside risk to our maximum employment goal and the upside risk to price stability. My assessment is that downside risks to employment have increased as the labor market has cooled, while the upside risks to inflation have lessened somewhat. Underlying inflation continues to trend downward, absent any evidence of second-round effects emanating from tariffs. For these reasons, I fully supported the FOMC's decisions to reduce the target range for the federal funds rate by 25 basis points at each of its past two meetings. Looking ahead, it's imperative to restore inflation to our 2% longer-run goal on a sustained basis. It's equally important to do so without creating undue risks to our maximum employment goal. I view monetary policy as being modestly restrictive. although somewhat less so than before our recent actions. Therefore, I still see room for a further adjustment in the near term to the target range for the federal funds rate to move the stance of policy closer to the range of neutral, thereby maintaining the balance between the achievement of our two goals. My policy views, of course, will, as always, be based on the evolution of the totality of the data, the economic outlook, and the balance of risk to the achievement of our maximum employment and price stability goals.
Yes, so that was William's take here on the potential cuts from the Federal Reserve. I'm going to see here we have a graph of the total assets in millions of dollars for the Federal Reserve going back to 2008 and going forward. And I think this graph is quite interesting when you are discussing the Federal Reserve and their monetary policies. So sure, the one thing they have on their hands is as a tool is the rate cuts, and it will affect people, especially short term, borrowing costs, etc., and also can affect inflation. And if you cut rates too fast at the wrong timing, you can have a very negative effect on inflation. And negative for me in this case is the inflation going up, which is making it harder for people to have a sustained living. People can be unemployed, etc. And sometimes it leads to inflation spiral where governments, just because it's getting cheaper to loan, they actually loan to keep up with the increasing cost of social services, etc. And the other part of the Federal Reserve where they have can affect the market is the amount of assets they have. And you see here during the pandemic, they have they were at these levels in terms of millions of dollars, and I mean it more than doubled until 2022, and that is why the stock market was increasing so much. It was just not just fundamentals; it was a lot of quantitative easing that led to a lot of money being flooded out, and in the long term, it reached as different asset classes like stocks, for example. So lately, the Federal Reserve has tried some QT, quantitative easing, tightening. I mean, so they have actually decreased their assets, and the effect this will have is it should lead to the liquidity being a bit harder for companies to get their hands on. But they have this hasn't really affected the market until now, because during this time where they just increased their assets under management extremely fast, they had an additional reserve called RRP, I think, and that reserve was about $2.5 trillion. And when they have done this easing, they still had that reserve that are sort of getting liquidity out in the market. But now that reserve is down to $2.5 billion, I think, the RRP reserves. And that means that we have a lot less liquidity in the market. And that is also why the quantitative tightening are ending for the moment, the 1st of December. This also means that the type of tools that the Federal Reserve has on hand is very limited, and we are in a moment where the market maybe have to manage itself a bit more, and we don't have that free liquidity coming from the Federal Reserve that we have had like in the last 5 or 6 years. And I think it might be an effect of this that we are seeing in the market at the moment. So according to, for example, the investor Katie Wood of ARK Invest, she says that she thinks the liquidity crisis here, she called it something like that, is temporary. I don't know if it's a crisis, but I think that based on my understanding on of these things, I think it will probably be long term also a bit tighter in terms of liquidity because of this. As I said, these RRP reserves are getting very low, and also that I think the Federal Reserve needs to go even lower in total assets under management. So they sometimes at some time need to continue their quantitative tightening, and that will obviously make it a bit harder for companies to get that liquidity, like cash on hand, as easy. So keep that in mind going forward. That it's not just a crisis or a bubble or an AI bubble or whatever. I think there are a lot of other things here that are affecting the stock market at the moment. So here I'm showing you the growing national debt of the United States of America. And sure, I've talked about the stock market, potential bubbles. I've talked about Federal Reserve and whether or not they can afford to cut the rates. And we need to talk about the increasing national debt of the US in context of all of this. You can just see how the total debt has just increased enormously lately, and now we are 125% debt to GDP ratio. And when we reach these type of numbers, historically, we can see a lot of countries over the world are getting a lot of problems. Um, the rich are often, when we are in this type of scenario, the rich are getting very rich in the countries and the poor are getting very poor, and we can reach a point where it can lead to revolutions, etc. So having the most influential country in the world having this debt to GDP ratio and this pure amount of national debt is a bit concerning. And in terms of the Federal Reserve and what they can do, this obviously is affecting a bit. So you might have heard that the government often want the Federal Reserve to cut rates, because then the manage of this total debt becomes a bit cheaper because the interest rates get lower. The problem with the Federal Reserve then cutting too much is um, it gets the inflation gets worse. So when we get an inflation spiral, obviously people lose their jobs, assets gets priced even higher because people don't want to save the dollars. They need to spend the money because before the dollars get decreased in value. And that in turn leads to higher social cost for people getting unemployed, increasing wage demands, and we have an inflation spiral going on. And also another problem is just to manage this enormous debt and still providing the social securities and services that are required for the people. So I do believe these enormous debt here are actually affecting the market as at the moment a little bit, and it also affects um, where the Federal Reserve are at the moment. So um, all these things together are important when you analyze what's going on. So I don't think we are in an AI bubble or asset bubble or something like that. I just like to look at the fundamentals of the companies to see where they are heading. For example, AMD, the stock price is has been losing a lot from its highs now. But if I look at the future revenue growths, the earnings prospects, etc., I'm still believe that they are heading to a specific point in terms of my analysis. And if I do that, the macro trends and the quantitative easing or tightening or federal rates cuts or increases, I don't just base too much of my investment in these type of things. But you should know that a lot of the big dogs out there, like hedge funds and banks, etc., they are actually following sort of how the liquidity are going during a year, so they can know that, oh, now we have with the Federal Reserves, our P reserves are getting low, so we will not have as easy anymore to have get cheap liquidity from Federal Reserve. So we need to bump up our own liquidity. So to do that, they might sell assets that puts pressure on stock prices, and that might be what's happening at the moment. Obviously, we have some tightening of the rules after 2008 when we have the banking crisis. So they have to keep some certain reserves, the banks. So there are a lot of things are going on, and we do know that the U.S. at some point need to address this total debt situation. I think in terms of doing that, and not just solving it with printing more money, will affect the stock market. And it's hard as an investor to know when this will happen, and if it will decrease the purchasing power of people out there, and if it will lead to unemployment, etc. So that is why it's hard to, I guess, bet short term on the marketplace. And you should not get stuck in the macro analysis too much, I believe. So for me, I still believe that long-term assets will outperform, like just saving your money in bonds, etc. And I believe doing your analysis and invest in certain type of companies that will outgrow the rest of the market is useful. So that is what I will focus on and do. And I will obviously analyze the U.S. national debt situation and the Federal Reserve situation, just to, if I understand more, that will make me feel more at ease with keeping my stocks at hand, even though the markets get jittery and the stock prices get lower. But obviously, we all have a breaking point. We need to do what feels good for us. Obviously, it's soon Christmas time, so understand what's happening, do your own due diligence, and hopefully, some of the information I provided you for today was helpful. This is the world, this is what is happening, and a lot of things is going on. It's not just about bubbles, it's about $1 trillion of debts. It's about quantitative easing and tightening at different situations, and Federal Reserve's RRP getting lower from $2.5 trillion. Liquidity for the markets now is just $2.5 billion left, etc. So a lot of things going on, but hopefully you survive out there and doing fine long term in the stock market. And I hope you have a great day.